I want to talk about property and some business taxes today. We start with some changes to VAT groups. The government are committed to extending the eligibility to non-corporate so that individuals and partnerships can group with companies which they own for the first time. The individual partnership must have a UK business establishment, be capable of VAT registration in their own right, and must control the body corporate. That's an important change for VAT groups. There's various procedural changes the government have made to certain aspects of the VAT rules. I won't go through them now, but they're on the slides if you'd like to read through them. One thing I would like to talk about is the government have published a document about what happens to VAT in a no-deal Brexit situation. I think that the key thing to say is the government have said that VAT is here to stay, and that in terms of any domestic transactions, the VAT rules will continue to apply as they do now. In terms of cross-border supplies, so UK businesses supplying, say, goods to VAT-registered EU customers, again, you can still VAT zero rate that supply, but the customer who receives those goods may be subject to import VAT and customs duty in their own country. One important thing is there'll be no requirement to complete EC sales lists, but there'll still be the same requirement to keep records as there is today. The other thing is important thing on importation of goods from EU suppliers and non-EU suppliers. The government have said that there'll be a postponed accounting procedure so that instead of UK businesses having to pay over VAT on importation, instead they'll simply pay that money over when they complete their VAT return. There have been some minor announcements in relation to supply of services. At this stage, there's very little detail on those. In terms of sort of property and construction sector, I mentioned this last year, and this is to say that the government is committed to implementing the VAT reverse charge on the construction industry, and they'll come into effect on the 1st of October 2019. And the government have said that they've actually published a draft legislation now, so the rules are a little bit clearer. But the key aspect to these rules is that if you've got a typical subcontractor-contractor relationship, instead of the subcontractor charging the contractor VAT on the services they provided, instead it will be up to the contractor to pay over that VAT to HMRC. Now, certain suppliers are excluded from this regime, so for instance, architects' fees, surveyors' fees, they don't fall within the scope of those rules. And anyone who is supplying to somebody who's not going to make an onward supply of construction services, those types of services are also excluded from the regime. One thing to say on this is there's definitely more onus on a construction company in making sure that they've operated the VAT rules clearly and know what their end customer is doing with supplies they're providing. There's also various things on the different types of VAT rates. Construction companies need to be very alert to the nature of the supplies that's being provided. A key change on stamp duty, land tax, extension of first-time buyers relief to in cases where people are purchasing shared ownership properties. These type of purchases are becoming increasingly popular with the affordability gap becoming larger. Previously, you could only get the first-time buyers relief on purchase of these type of properties where you were actually electing to pay stamp duty on the full market value of the property. You'll now be able to get that first-time buyers relief on purchasing the first share under your co-ownership agreement. But obviously there's no relief there if that property is valued over £500,000. They're extending the time limit for claiming repayment of the 3% surcharge. These typically apply where you buy a property intending it to be your main residence, but you still haven't sold your old residence. There used to be a very narrow gap for claiming the refund, and that's being extended. They'll be reducing the time limit to file SDLT returns from 30 days to 14 days, and that'll be effective from 1st of March 2019. You'll have seen the government announcement on reduction of business rates for retailers being reduced by 1/3 for businesses with a rateable value of less than £51,000. And also the government are talking about reforming property developer contributions, things like looking at the way community infrastructure levy works and Section 106 obligations. There's a reform to the EIS rules in terms of approved funds. Again, going back to Grant's point on the government's commitment to research and development, they're making these funds look towards investing in these types of companies by giving them sort of increased tax breaks. Entrepreneurs relief, there's a couple of key changes on this one. There's 2 new additional tests which will have to be satisfied to claim entrepreneurs relief, and that is the investor must have a 5% interest in distributable profits of a company and 5% interest in the net assets of the company. At the moment, the only requirements are that you must have a 5% rights to vote in the company and 5% of the issued share capital. So this might mean that growth shares will no longer be able to benefit from entrepreneurs relief. They're increasing the minimum qualifying period, so you'll now have to hold the asset for 2 years rather than 1 year to benefit from entrepreneurs relief. There was an interesting paragraph in the budget notes talking about the sale of shares, which seemed to suggest that you would have to have a 3-year holding period rather than a 1-year holding period. It's difficult to see whether that's a typographical error because it was not mentioned in any of the other notes, so we'll have to wait and see on this one. Again, these rules will apply from today. There's also an extended relief where someone holds a 5% shareholding and they're then diluted because another investor has come in, which has meant their shareholding has reduced below 5%. Entrepreneurs relief will be available, but it will be available on any gain up to the date of that investment. And I just wanted to remind you of investors relief. This came into effect in March 2016 for shares issued on or after that date, and it's typically aimed at people who are not employees, who are not working in the business. They're genuine outside investors. And under this tax break, if you hold the shares for 3 years prior to disposal, the company's a trading company, you could get 10% capital gains tax relief on sale. I mention this now because we're coming up to the first lot of investors who will be able to benefit from this relief. Thank you. I'll now pass you over to Jason.